This is the One Point Podcast. I'm Rohit Yadav. Today, we are covering venture asset class from an emerging manager perspective, while specifically talking about the emerging manager fundraising situation. And to do this, I have Matt Curtolo joining me today. Matt, thanks for joining in.
Thank you. Great to be here.
Matt is an experienced LP and allocator with over 20 plus years of experience in private markets. He started his career at Hamilton Lane, and since then, he has led investment teams for institutions, including also CIOs and insurance investor like MetLife. And most recently, he was one of the non-founder hires at fintech startup Allocate, where he built the investment program from ground up. Currently, Matt holds several advisory positions that includes in the startups, asset management firms, and fund of funds. Interestingly, he also manages an advisory practice, providing GPs with strategic guidance on LP engagement, investor relationship, as well as fund and firm building. So he's kind of the perfect person to talk about emerging manager ecosystem. So Matt, I hand it over to you, and if you can briefly introduce what kind of projects you are leading these days.
Yeah, absolutely. Well, thanks for the introduction, and it's always interesting to hear it back to me. Having lived all these experiences, started in the industry 20 years ago, and so what I'm doing today is leveraging a lot of those diverse experiences. So when I think about it, I've invested on behalf of some of the largest institutions in the world, some of the smallest in terms of family offices, individual to new growing sort of retail investor class. I've been responsible for building investment portfolios for those investor types, managing fund of funds, investing, on behalf of one of the largest insurers in the world, meaning being in the room, being in the limited partner advisory committees, writing the largest check, managing relationships, and then most recently helping build a business around the venture capital ecosystem and bringing more folks, both sides. So bringing emerging managers to more investors, this emerging retail class. So putting all that together, about a year ago, I started an advisory business where one continued to work with LPs in the same capacity I had in my prior roles,
Okay.
but really turned my attention to GPs. And that's really the function of this emerging manager ecosystem development. So there are folks who are new to the asset class, any asset class. Emerging manager can mean a lot of different things to a lot of different people, but someone who's newer to the asset class and really looking for a river guide, so to speak, of just how does this world work? How is the best way that I can tell my story to the people that I need to secure capital from to be able to run my business, right? So that's, in a nutshell, my role is really being a strategic advisor and the voice of an LP within the GP's four walls, helping them everything from storytelling, deck creation, can take a lot of different shapes, as much as it could be a very mature firm looking for more point solutions around portfolio construction, LP expansion, things like that. So I get to leverage all that experience from my last 2 decades in the asset class in a lot of new and creative ways, working with some interesting folks.
And nice to hear what you're doing for the ecosystem. So kudos for that. What's the top question that you're hearing?
Well, the number one ask is can you make some introductions for me? If you read between the lines there, the biggest question is, how can I effectively fundraise in this market? And this is from folks, as I mentioned, kind of from the fund zero, raising their first fund, all the way through to funds that have been around for 10, 12, 15 years. So that is the overarching theme that people are asking about, people are thinking about, people are trying to address. And then, I think the answer to that question is the ever popular, it depends, right? So depending on where you are in your life cycle, the strategy you're operating under, the type of capital you're trying to raise, all those things go into kind of how I respond to those folks. But that's definitely top of mind for everyone.
Okay. So it's a perfect segue into explaining the audience what actually is an emerging manager, right? So specifically with respect to VC, because it can mean something different for different asset classes to some degree. For VC itself, and there are many definitions out there. So try to capture everything. Who is an emerging manager?
Yeah, so emerging manager tends to mean, and you addressed it well there, with different LPs have different definitions. a lot of LPs have programs that have pre-specified ranges of the key dimensions, I would say, are tenure. So likely these are groups that have been around for, could be less than a certain number of years. I'd say the way I look at it is less than 8 years. And then fund number. So have you raised more than 3 funds, or you're raising your 4th fund? So funds 1 through 3, less than 8 years old. And generally some people put a fund size ceiling on this. So call it 100 million, 150 million. At Allocate, we had some flexibility, to go up to 200 million. All of these, I'd say, are loose ranges. But when you think by and large, that's going to be what defines an emerging manager. It's tenure based on fund number and years, and generally fund size. I would say stage almost naturally falls out of that. In VC, you tend to see most of the emerging managers focused on pre-seed and seed.
Okay.
In some cases, it might be a Series A fund, but generally the fund size is going to dictate more of an earlier stage strategy.
Okay. And when you mention these numbers, you're mentioning the AUM size, which is assets under management, or you're talking about 100 million as a single fundraise?
Yeah, I'd say 100 million as a single fundraise.
Okay.
If you had raised, let's assume a firm is 7 years old raising their 3rd fund and had raised $20 million fund, a $40 million fund, and is targeting an $80 million fund.
Okay.
That's where it's a little bit of a gray area, right? Because you have enough history where you've raised funds, you have a portfolio. Another way to look at it is how, as an investor and an allocator, can I underwrite this fund? In Fund 1, it's really just the story. There may be some historical track record from prior organizations or as an angel, but Fund 1, you're really heavily leaning into the qualitative. There's not much in terms of data to dig into. As you get to a Fund 3, it might be a little bit more quantitative because you have a portfolio, you have investments that have been made. Likely you've had things that have worked and things that haven't. So you have a little bit more of a body of work to address. So that's another lens you can overlay on top of just the more metrics driven of just number, fund, AUM, all those sorts of things that kind of quantify that. But how are you going to be able to underwrite that as an allocator?
Got it. And so it's a perfect time to also discuss about the dynamics of emerging manager ecosystem.
Yeah.
There's a history to how it started and how it evolved. If you can capture in details, how is the ecosystem looking right now, where it's coming from with respect to growth, size, number of emerging managers, and maybe also to some degree geographically, right?
Sure. We may need a longer podcast for this one, but no, I think that it's amazing. I actually did some research to try and find out where the term emerging manager came from. And
Okay.
there's no one data point, but I would say the emergence of this as, I'd say, common nomenclature in the LP language or the ecosystem language was probably in the mid 2000s. So
Okay.
there were enough groups that were mature where you're starting to have spinouts, and those were labeled as emerging funds. Now, these were more, I'd say, more akin to an experienced investor or an experienced group of investors. I remembered early in my career, 2005, having invested in a firm called Spark Capital, which was a spin out of partners came from CRV and Battery. So that's a firm, firms that have been around for a long time. The partners are well established, had their own track records. It doesn't look quite the same as an emerging manager today, but that was really the opportunity for firms. There were mature enough firms that were sprouting some of this stuff. So think maybe 20-ish years, the emerging manager ecosystem started to develop. I used that fund as a line of demarcation. Not that there weren't things before that, but that was something we can point to. It also was driven by appetite from allocators to continue to diversify portfolios. So if you think at the highest order, let's take a public pension, for example, there's certainly a public equities, public fixed income exposure. There's a real assets exposure. Alternatives really started to grow during that period.
Yeah.
And then alternatives took the shape of it was private equity and other, I would say. Private equity included venture capital, and venture was more of a cottage industry at that point. You still had a lot of emerging firms. You had just gone through the dot-com bubble. And now you had firms that were a little bit more established and others that were coming up. So as that allocation continued to bifurcate, so you had PE and then you had venture capital growing, and then you had growth equity, and then you had all these different pieces, effectively gave people the latitude to invest in newer and emerging firms rather than just looking back to what was. So these firms were just being created out of out of thin air effectively. So these were experienced operators, experienced investors. So that's really the genesis of the ecosystem. And I'd say over the last 10 years in VC, you really saw an emergence. Both it was enough folks with experience that could go out and launch their own funds, and you also had this operator mentality too. So it was folks who had been within firms, and then you had the different archetype of an operator who worked in a big tech company who wanted to go out and invest, had maybe been an angel investor before. So you saw this influx that really hit a peak kind of in the late 20 teens, 2020, the number of emerging funds that were raised. I think too, it was an easy money environment, certainly here in the US, where it was much easier to raise funds than it is today. So you saw this huge influx where I think there was something in the order of 1,500 new funds created over an 18-month period. So that's something it's hard to wrap your head around. It was more than what was created in the prior 5 years and the prior 10 before that. So think about just the progression in a 2-year window. Effectively, you had, I won't say a doubling of the folks of the active firms, but you had a huge spike. And what that did, unfortunately, when times were easy, these groups raised perhaps without the expectation or without the understanding of how challenging markets can be. And the reality came in as the markets continued to shift more bearish. We had a lot of idiosyncratic events, but macro events. And then where we sit today, 2024 was perhaps the worst year on record for emerging manager fundraising, where I think there were only 77 emerging funds that closed during the calendar year. So think about that juxtaposed to 5 years prior. So it has kind of gone through that swing, and all those firms that raised in the 2019, 2020, 2021 era are looking for fund two, and it's increasingly challenging. They still fall in that emerging bucket. They may have bought at the peak. There's a lot of dynamics that are going to make it increasingly challenging to go and raise more capital.
Okay, so we'll discuss this fundraising part in detail, but what I would love to know from you right now is these emerging managers, I think they are focusing much more on the seed stage or the pre-seed stage, right? Just due to the mechanics of how those funds are built. And typically they are raising obviously below 100 million, right? So that's kind of the area where these folks are coming up. And as you mentioned nicely, like the most boom happened due to the easy money regime to some extent.
Sure.
How do you see this going on for the next couple of years? Not in terms of fundraising, but in terms of the ecosystem overall.
Yeah, there's a lot of ways to approach it. One is kind of look at what's the underlying investment in venture capital. It's technology, it's innovation, and you could argue that if you look back at recessionary periods, that those have tended to be some of the best times for great companies to be built. People are scrappier. People may have lost their job and are looking, kind of that nothing to lose mentality. So you have entrepreneurial activity that persists regardless of what the interest rates are or what the macro environment is. So I go back to that and say, right now is as good a time as any for company formation. I think we're going to continue to see that pace, persist across geographies, but at the earliest stages, that provides opportunity for early stage funds to support those companies. So take that dynamic of just what do we think is going to happen over the next few years. Innovation is agnostic to the market cycle. Now, thinking about what the readiness and willingness of people to invest when there is, I'll use news of a US election, people are waiting around, global unrest, all of the macro policies and macro events that have an effect on how people think about allocating capital. People still view venture capital and then the earliest, the seed stage, as the riskiest of the basket. So in a risk off posture, so when the market is saying, there's uncertainty, there's volatility, the rest of our portfolio looks different. We saw in 24, there was a lot of folks sitting on their hands. So there was a lot of inactivity. And you saw it across the board, both in investment activity and fundraising. So do you think that's going to continue based on perhaps a little more clarity in the market and people more willing to invest? So I think that's what we're going to see over the next handful of years. Continued company creation globally. I'd say an increase from 2024 lows of all those activity levels, both the fund and the investor level. And then I'll caveat all of that saying we can't predict. I'm certainly not a macroeconomist, but I can't predict what or where the next big event is going to happen. But people are certainly pricing in certain components of what could happen as we sit today, thinking about tariffs globally.
Okay, got it. So let's just focus now on the fundraising topic because this is much more exciting. And you can bring all those macro, how the ecosystem is looking at all those trends within your answers. So fundraising, as you mentioned, has been hard, really hard for emerging managers for some time now. LPs are a bit reluctant to invest in emerging managers. So we're not just talking about venture as an asset class, we're talking about emerging managers. So if you can expand on that and why it has been this way lately, last year as well, and how do you see this going on further?
Yeah. Well, I think there's the overarching macro view, but taking it down. So you have all those components that may give people some unwillingness or some doubt about where the capital should be invested. I think the other reason why it's challenged is that dynamic of a lot of people empty their holster, so to speak, in that 2019, 2020, 21 timeframe. And that was actually a lot of new entrants. So for my time at Allocate, working with family offices and wealth managers, these were new entrants to the asset class. And you could argue at precisely the wrong time at a market top. So
Okay.
there's a little bit of scar tissue, I'm sure, from those groups who made their first foray into the asset class at a time that was arguably really frothy and really, really toppy. So some of that is rippling through. So you can see today one of the reasons why fundraising has been challenging is because so much capital was deployed. Much of that capital was invested and not necessarily showing a return yet or a negative return. Some of those companies have been marked down or are underperforming. So people have a little bit of a bad taste in their mouth.
Okay.
The other dynamic that we talk about is a lot of the liquidity in the asset class. So this idea of DPI, distributions to paid in, that's a metric that has become in laser focus. Normally the holding period for an early stage company was somewhere around 7 to 8 years. That's
Yeah.
ballooned now to about 10 or 11 years, depending on what data you look at. And if you think about the dynamics that an LP needs to have, they're deploying the capital. There's a time horizon where they expect that capital to grow and compound. And then there's an exit event. So if that exit event doesn't happen in the time frame where they were originally projecting or thinking about, they don't necessarily have new dollars to deploy into that space. So they're a little bit hamstrung in terms of being able to deploy new capital into new funds because there's still a lot of that value trapped in some of those existing positions. Now, I would say we haven't seen, there's a lot of talk. We haven't seen much in terms of IPOs or M&A activity.
Mhm.
That those liquidity mechanisms haven't been turned on yet. So I think people are still waiting for that. There's more optimism that they're coming, but people are still waiting for that liquidity event so they can feel a little more comfortable deploying fresh capital and putting more dollars to work in there. And
Got it.
yeah,
So
go
I
ahead.
captured three core points. One is obviously the macro we discussed what led us here. Second is what you mentioned, maybe the timing of some of those LPs getting into the market when it was at the peak in 2020 and 2021, and then having a bit of this scar tissue topic that you mentioned. And the third thing is the DPI, getting the returns back from the asset class. When I look at those 3 points, these are all actually asset class relevant. They're all common to all the managers, not just emerging managers. So now I want to know from you what's so specific about emerging managers, which LPs are not liking.
Yeah, so I'd say in a time of uncertainty, the flight to quality or the perceived quality tends to
Okay.
happen. So if you look, there was a chart that PitchBook put out last year. I think the top 9 firms raised
Yep.
50% of the capital in venture capital. And those were the big platform firms. That was Andreessen Horowitz, General Catalyst. There were a lot of groups that were raising multi-billion-dollar funds. So reading the tea leaves there, it's investors still had appetite for the asset class, for venture as a whole, but where their dollars migrated to, maybe they did have an allocation to emerging managers before, but more of those dollars got concentrated in those larger managers. Whether that be, I can speak from having worked with very large allocators. Investing in small funds is tougher because you can't get that economy of scale of I could put a large check into these funds and get the exposure I'm looking for and a single line item to monitor. Whereas investing in emerging managers might require me to do next the work to get those. And even if the returns are expected to be higher, that may be some component of how they think about investing there. So you have, from an emerging manager perspective, more dollars flying to the larger perceived safety of larger firms. We could talk about, the return expectations for what a 5, 7, $10 billion venture fund could deliver relative to a 50 or $100 million. I think it's intuitive that you can generate bigger multiples on those smaller funds. But I think LPs were more than willing to sacrifice some of that upside for the safety and security of the franchise and platform funds at the larger end.
Got it. So it's more familiarity with the VCs or kind of the maturity of VCs, so to say, which is driving this. But there's still this point of emerging managers largely focusing on the very early stage, which is pre-seed and seed.
Mm-hmm.
So with respect to that as well, you're saying the capital, even if it's going on those two stages, it's going to the managers who have been there focusing on these two areas of investments for a very long time. So even within that pre-seed and seed space, the LPs are favoring established managers who have been doing this for 10 years or maybe 15 years rather than the emerging managers. Is
To
this fair?
some degree, I think that's where the nuance comes in, because a lot of groups that were successful at pre-seed and seed have tended to migrate up or have become multi-stage firms,
Okay.
right? So if you think about, let's use an Andreessen Horowitz, for example, they still invest in seed and early stage companies, but the propensity of the dollars to go into a seed company in a platform of that size, the numbers just don't necessarily map out. So they're still actively investing there. But from an LP's perspective, they're eliminating one of the risks that they have to underwrite, which is organizational risk. You can look at a 5 or 6 or 700 person firm like that. And this is not to say anything negative about Andreessen Horowitz. Great firm, great
Yep.
platform, but it's a different dynamic than if I have to underwrite that fund one. And to the point I made before, underwriting a story, and I really have to have high conviction in this to put my capital to work in that fund versus the old adage, you won't get fired for buying IBM.
Yep.
As an allocator, the risk of investing in an emerging manager that potentially goes under or is not successful in raising another fund, or worse, is much higher than investing in a large established platform firm where, like I said, it's not necessarily the returns that are driving that decision. There's a lot of other components that come into there. So I think those two things are really where,
Got it.
where LPs have gravitated towards those firms. I still think pre-seed and seed is going to be an emerging fund game, because if I look across the firms, across the 500 or so firms that I've invested in over my career, many of those started as seed and early funds, and as they've progressed, have outgrown that space to either abandon it entirely or include follow-on stages that changes the dynamic in terms of the overall return profile of the fund.
Okay, so what I'm getting to is maybe what you're saying is there's a mismatch in expectation versus reality. For example, there's a saying that at seed and pre-seed, it's an open game, right? Because we don't know what startup will ultimately reach to the IPO level or have that 10x or 100x exit.
Mm-hmm.
So it's a bit of an open opportunity. And when it's an open opportunity, emerging managers, that's why are able to focus and on those kind of niche areas and deploy capital. However, the capital from the LPs is going more towards established managers. So they're just watching this one layer of reputation, maturity, and that's it,
Mm-hmm.
at least for now, obviously. And so there's a mismatch with respect to the allocation versus what this pre-seed and seed stage has to offer. Could you get my point, what I'm trying to
Yeah.
explain?
I think you hit the nail on the head, right? None of this is an indictment on the industry or the
Yeah,
innovation
sure.
idea, or what I do think is there are too many firms now. We saw this huge increase. So there are firms, I would never say this to many of their face, but they don't really have a role in the ecosystem today. They are deploying capital, they've raised capital, but how many venture capital funds do we really need in the ecosystem? So I think there's been a proliferation of firms, and now I think we have to have some of that culling of the herd where we
Okay.
get back to folks. And I think for entrepreneurs and founders, it's great to have choice. And that's where I see a lot of the pre-seed and seed funds being a lot more successful. To your point, being an open game, you can, if you're raising capital at the seed stage, you can be laser focused about building your syndicate of, a firm that has deep industry expertise, a firm that has a particular skill set around fundraising, whatever it might be, whatever you're looking for. There's the Muhammad Ali, I think, is credited with the quote of it's different strokes for different folks, right? So
Okay.
it doesn't really much matter in terms of that every founder is going to be looking for something slightly different. And as an emerging manager in particular, you have to position yourself to be able to be that unique value added resource and capital provider. If it's a really hot company, obviously people are going to be falling all over themselves to throw money at it. But part of that game is putting in the groundwork, understanding where your value is.
Yeah.
And a lot of the work I do today is with emerging managers trying to capture that, because then you go past the idea of we do have a reason to exist. We do have a place in the ecosystem. Look at the value we bring to a lot of these companies.
Okay, so it's a perfect segue into the next question that I was about to ask is what do emerging managers need to win LP's capital in today's environment? So one point you already mentioned, it's about storytelling, right? And what could be more points?
Yeah, so I think it's introspection first. A lot of the questions I ask folks who are thinking about raising a fund is, one, do you really want to do this? And I overlay a lot of the things we just talked about. Last year was the worst year for emerging manager fundraising and venture. Raising capital is not easy in any market. The average
Yeah.
time in market, if you look for emerging managers, I believe it's another PitchBook stat, it's about 13 or 15 months, depending on the year. You have to commit to a full year plus of going out the ground game and really understanding how to build an LP funnel and close investors. And then you also have the proliferation of funds. The competition is a lot higher. So first and foremost, it's just like, do you really want to do this? And understanding what the journey is going to look like. A lot of people go into this with that same expectation from 2020, like you can snap your fingers and raise capital, but it's a much different environment and landscape.
Much different. Yeah.
So of course, then you go to the story, right? Okay, what is the background? I use this idea of GP thesis fit, and that's, are you the right person to be doing the right thing at the right time? So you can control the right person and the right thing. That's the introspection piece of understanding who you are and what you do. The right time is understanding the market overlay. Just, am I doing something where there are secular tailwinds? You can certainly look at things like AI. Of course, the market is absorbing a ton of capital around AI businesses, but you can think about healthcare. That is, I think, crosses a number of cycles and ways to address. So thinking about approaching a sector like that in a unique way, that puts you in a position, but making sure that all of those things fit. And so we're not even at the point of pitching to LPs yet, but really tightening up that story, your unique value add and perspective. When we go to think about convincing LPs, a lot of the work has to be done up front in terms of understanding your ICP. Like, who is your ideal customer for your fund? And you think about, if I'm raising a $10 million first time fund, I shouldn't go pitch MetLife or Allianz or any public pension. There's just a mismatch in terms of the expectation. And surprisingly, a lot of emerging folks, that's their first port of call. That's where they go. They think they're going to be able to raise capital there. But really understanding that first degree network, test that thesis out, continue to build out, just making sure you understand who the right people for your type of fund is going to be. And then beyond that, convincing LPs that, one, you have the experience, your credibility is there as an angel investor, as an operator. It goes back to that thesis fit. I'm the right person to be doing this right thing now. So convincing the LP of that, whether that be tangible through an angel track record, through the operating experience that you have, whatever it might be, bring that as much to life as possible. So the allocator can look at that and say, okay, this is real, this is credible. You have the other piece of how this fits in the ecosystem. Everybody talks about differentiation and being contrarian and all this sort of stuff. My view is you don't have to be different necessarily. You just have to be better at a lot of these things. So you certainly can go in a place where there's a lot of white space and attack a market that hasn't been attacked yet. but you can also continue to do something that's in the market where you feel like you have that unique edge. So putting those two pieces together, knowing your LP, understanding your story really well, how you
Mhm.
fit, and how that drives forward. And I think being flexible is the other piece. There's,
Okay.
I wouldn't say make concessions early on, but trying to get into business as an emerging manager, and this is much more for a fund raising their first fund rather than beyond that. But you really do have to think about, what do I have to do to get an anchor to get this thing off the ground? I may have to give some economics to that LP. I may have to provide co-investment deal flow. There's just things, making sure you have an open mind in terms of being able to, yes, I can convince you that this is there, but getting an LP over the hump today is really tough. So a little
Mhm.
bit of a sweetener can sometimes help get across that finish line.
Got it. I want to flip the sides and I want to ask, what are the top three questions that LP ask emerging managers, right?
Yeah, I think so. So LPs, well, let me answer it two ways. Right? In the first case, I find it very interesting that folks ask emerging managers about performance. Right.
Yeah,
In
that's
my
like,
mind,
okay.
yeah, in my mind, it's not. And really, talking to my allocator friends, like a lot of this is people, process. There's the four P's, right?
Yep.
People, process, performance, portfolio, or philosophy, whichever one you want to pick. Maybe we should just call it five. But it really ends. Performance is in the bottom half of that. So it's always people and process, because those are the things that are repeatable and I think durable. So the LPs who kind of lean in and say, okay, how have you done? How's your 2022 fund performing relative to benchmarks? Wrong question, right? The questions that LPs should ask, and I think
Hmm.
a lot of them do, is understanding, one, why, how you got here as a GP. You've now determined that going down this difficult path is where you want to go. LPs are trying to assess, the conviction in the strategy, the natural fit,
Hmm.
that sort of alignment with, I have the skills and background, but I also have a passion for it. So what we say, it's kind of the intangible P. Passion is definitely in there, understanding how that really grows. And I think the other questions LPs ask about is, how are you going to win? It's a bit of a
Hmm.
generic question, but it does put into the mind of the GP and lets them say in their own words that exactly. Like, what are the differentiating factors where they're going to be successful, that they view that they're going to be successful? As an LP, then I can take that back into the bank and do my reference calls and do other work around trying to validate that. But admittedly, it's hard as a fund one. As an LP, I want to get as many pieces of information as I can. They're not going to be the same way I would underwrite a fund 10, right? I don't have the full data room with all the prior track record
Yep.
and all the companies. I can't slice and dice and do that deep attribution analysis that, is going to give me a lot more fodder to talk with that manager. I'm really digging into, how did they grow up? What is their rationale for doing what they've done? Why this now? All these sorts of things. And it does lend itself back to, the GP has to be really strong in conviction around that and being able to tell the story concisely.
I loved your point of mentioning people and processes and the focus on that. That's what I did in my career as well. And actually, it comes from logic. So there has been studies done, not in venture space, but in equity space. Nonetheless, the single biggest factor of success, according to one study, is the processes, the repeatability of how you're doing investments is the single biggest kind of prediction power to the success of a manager. It kind of lends to what you are saying. Have the focus on whether it's repeatable, how the fund manager is doing investments, who's behind, sitting behind, what is the thought process, and so on. I want to ask a nuance over here. So, how do you see the difference between a 10 million emerging manager fund versus a 75 million emerging manager fund? Do you see like radical differences in the current market with respect to fundraising, with respect to all those points that you have mentioned, people, processes, and so on, and also with respect to how the LPs are perceiving
Mm-hmm.
those emerging managers?
Yeah, it's a great question, because I think that is, saying emerging managers is like saying equities, right? It's a blanket statement, and a $10 million firm is definitely different than a
True.
$75 million fund in a couple ways. I'd say being above a $50 million threshold, there's this, you'll probably remember this from your allocator days, that a 10% rule. An LP doesn't want to be more than 10% of a fund.
Mhm.
And getting over a certain threshold, I think depending on the organization, writing a $5 million check into a $50 million fund is something that they could wrap their head around. $5 million may be meaningful enough in the overall portfolio. It's a little bit arbitrary, right? Like, okay, I'm raising 40. Does that change if it's 50? But there is a mentality where certain LPs will just draw that floor and say, if you're not over this, I can't even look, because I can't even squint to get to an allocation that makes sense for me. So one, raising slightly more opens up the door to to more LPs potentially, or more diverse LPs. You also have the perspective, I think the portfolio construction model has to be super tight at a 75 versus a 10. A 10, the likelihood is you're going to write a number of pre-seed, maybe follow on and seed, or maybe you're going to have a no reserve strategy. You're not likely to be able to lead any of those deals. So it's pretty clear. I mean, you have the levers to pull, but raising a $10 million fund, it's not likely that you're going to have a ton of different flexibility on that. At 75, the portfolio construction model is what I'm spending more time on. How many first checks are you going to write? Are you thinking about entry point, ownership, valuation? A lot of the stuff that really comes into, I'd say, a more nuanced framework from an LP's perspective. You can also think about just where that fits. At 75, you probably can lead rounds. You're probably in a situation where you're going to follow on or have a really diverse portfolio. So I think it changes the flavor a little bit. It doesn't have to materially, but just, the quantum of capital does end up changing there. So spending a little more time as an LP with a $75 million fund on the how and the why, and then the mechanics of building that. You're going to be competing then. Being a non-lead versus a lead changes how you go to market with entrepreneurs and founders. Some of them are looking for leads. It's great that you can catalyze a round.
Okay.
If you're not leading, more than likely you can have a value proposition that fits into almost any round. So you have those different dynamics as well.
Okay. And maybe one of the last question is, how are LPs looking at emerging managers? And what I want to say with that is there a complete no-goes in the market right now? So for example, there could be topics like, hey, you know what? For most of the LPs, we don't want to invest in solo emerging managers. I'm just taking a random example. I'm not saying that they're good or bad, but I'm just taking an example. So are the LPs right now thinking about no-goes? So their starting point is like all the no's and then you get to a yes? Or is it more like you have a checklist of, the emerging manager checks on this and that criteria? For example, it could be a bigger fund. It could be we only invest in 50 billion plus emerging manager funds and so on. So how do LPs think about this ecosystem right now?
Yeah, I think there's two. Well, let me say first, I think if you think of the LPs, again, a blanket statement, a individual or a family office is probably going to view this differently from an institution.
True.
Family offices, they take different forms. Again, another statement that we can split up in another part of the market. The institutional side of this is going to start with the no, right? And kind of work their way back. Okay, it has to meet these 5 threshold numbers, number of years of experience, number of funds under their belt, whatever it might be, size, team, whatever it might be. You set up that checklist. And I always joke, LPs are looking for reasons to say no, right? and I say that anything that hit my desk is a default no, right? I'm starting with no, and you have to convince me to yes as a new fund. So that's generally, there could be a checklist, or it could just be, look, we have room for 1 or 2 emerging managers this year in our portfolio construction. And that's kind of the institutional side. So that's definitely the first that you said, is like they're ticking down through the things that it can't be, or the things it needs to be, and disqualifying straight away. Where I think family offices, individuals, this whole growing institutional retail market is a lot more open to say, oh, I'm looking for something in this space or this space, and I'm looking for an emerging manager. It has these qualities. So let me turn the page. Let me dig a little deeper on that fund and firm. So there's a little bit more propensity to dig in from that class of investor versus the institutions, as you and I both know, have a lot of other things going on, a lot of other considerations to make. And, thinking about a small emerging manager may not be top priority on their list.
Got it. I loved your answer on kind of dividing with respect to the LPs in specifically. So last question from my side, Matt. we covered a lot of points, right? So is there something that we missed that you want to focus on and tell the audience about fundraising specifically to emerging managers and how they should look forward projected to 1 to 2 years? I know it's difficult always. Predictions are always difficult to make. But
I have, a lot of predictions around where I think things are going to go.
okay.
The one thing I would say is right now, and I'd say it's less of a prediction, but I'm feeling and hearing a lot more optimism from the LPs that I'm talking to. Goes back to the dynamic mentioned
Nice.
before, where 23 was tough, 24 was really tough. Some people are just tired of waiting, right? They said, look, okay, we've been waiting for things to settle down. Is the environment good enough? Are we seeing? So you don't want to say the bar's been lowered, but I do think there's a level of optimism that the market's going to get better on a macro level. And from an underlying perspective, the quality of investments are still there. And as you know, from a pacing perspective, you can't sit out for that long. Otherwise, you start seeing that runoff and your exposure will change dramatically in the out years. So that's, I think, one thing that will give both emerging managers, I think, hope around more and more people. I know the first 2 weeks of January had a lot of conversations with folks of just,
Okay.
hey, what's really new and interesting and fun coming out? What are things I should look at? So that was not the case 6 or 9 months prior. It
Got
was
it.
quite the opposite.
So a lot of optimism.
A lot of optimism, and I'd say too, I think you are going to see the market coalesce around the small funds and the platform firms. I don't think this is controversial. I think you're seeing it already.
Okay.
You either need to be a small, nimble team fund firm where you're investing at a particular stage with a particular set of capabilities and specific strategy. And then you're going to have the platform firms that can do all things to all people and cover a lot of ground. And then in the middle, you're going to have folks that just don't necessarily gravitate towards that. They're not differentiated enough to compete with the small firms, and they're not big enough to necessarily compete with the bigger firms. So I think you do have two ends of the spectrum in terms of where LP dollars are going to go. So for emerging managers, that's probably another positive signal.
Okay.
But recognize that you're going to be competing with likely, how do you unseat or take capital away from one of those larger platform firms?
Got it. Thank you, Matt. Thanks for explaining so many points and covering different aspects of the emerging manager ecosystem. I know it's one of the hottest topic in the sense you hear most noise, like I wouldn't say noise, but rather social media information. Everything is going on every time, but it takes such podcasts to kind of focus on these topics and then cover the specific parts of the entire value chain, like fundraising in particular. So thanks, Matt, for joining in. Love the conversation.
Absolutely, Ro. It was a pleasure. Thanks for the thoughtful questions and great to speak.
Thanks.